Millions of Americans are about to discover they can suddenly qualify for mortgages they never thought possible, while homeowners with low interest rates might soon be able to pack up their 3% loans and take on any house they want. And this isn't some distant fantasy. This is happening right now and will fundamentally change who can buy homes in America. If you want to stay ahead of massive financial changes like this that could directly impact your wealth and housing opportunities, make sure to subscribe and hit that notification bell, because we break down exactly how these industry shifts will affect real people's lives, not just market theories. The information we're about to share could be the difference between getting locked out of home ownership or finding opportunities others don't even know exist yet. The real estate market is about to experience changes that could completely flip everything on its head in ways not seen since 2008. Right now, as viewers watch this content, one of the biggest mortgage giants in America is eliminating credit score requirements entirely, while at the same time, there's serious discussion about creating something that sounds almost too good to be true, portable mortgages that would allow homeowners to take their amazing interest rates and move them to their next house like switching phone carriers. When people thought the housing market couldn't get any crazier, the industry is about to witness changes that could create massive winners and even bigger losers in the coming months. What's happening right now isn't just another policy tweak. These are fundamental shifts that could unlock hundreds of thousands of properties that would otherwise never hit the market, potentially changing everything about how Americans buy and sell homes. The first bombshell that's about to hit the real estate world is happening in just a matter of days. On November 16th, Fannie Mae officially eliminates their minimum credit score requirement of 620, and this isn't some small adjustment. This is a complete overhaul of how mortgage approvals work. But before anyone starts thinking this means lenders are just handing out loans to anyone with a pulse, it's important to break down exactly what's really happening here and why it's way more sophisticated than it might sound on the surface. To understand why this is such a big deal, people need to understand how the mortgage system actually works, because most home buyers have no idea what happens after they sign those papers at closing. When someone walks into a bank and gets approved for a mortgage to buy that tiny one-bedroom apartment in San Francisco for $2 million, the bank isn't planning to sit around for 30 years waiting for monthly check payments. Instead, what banks do is bundle up all their mortgages into one giant package and sell that package to investors as something called mortgage-backed securities, making a nice profit in the process. This is where Fannie Mae and Freddie Mac come into play. And while their names might sound like a couple of rival rap artists, they're actually federally backed mortgage companies that buy and guarantee loans made by banks and financial institutions. Back in 1938, the government created this system as a safety net to ensure these mortgage-backed securities would always have buyers, even when private investors weren't interested in purchasing them. Here's where things get really interesting and why people are starting to pay attention. Over the past few years, Fannie Mae and Freddie Mac have been steadily increasing the amounts they're willing to finance, raising their loan limits from around $500,000 in 2020 to as much as $1.5 million today for buyers purchasing 4-unit properties. The idea behind this is simple. Home prices have skyrocketed, so they need to make it easier to get bigger loans approved, which expands the pool of eligible buyers. Now here comes the part that's making headlines and causing some people to worry. Starting November 16th, Fannie Mae will no longer require that minimum credit score of 620 that's been standard for so long. According to their official statement, this change is designed to expand access to home credit, particularly among borrowers with limited or non-traditional credit histories. Instead of relying solely on traditional credit scores, they'll be using their own comprehensive analysis of risk factors to determine eligibility. But what exactly are these risk factors they'll be examining? The company has stated that their underwriting standards remain the same, but now they can consider alternatives to regular credit history. Something called a Vantage score. This score looks at payment history outside of normal credit profiles and can include things like rent payments, utility bills, phone bills, and anything else that might not show up on traditional credit reports. From their perspective, this change would allow many more people who would otherwise be locked out to qualify for loans. Consider someone who's been paying rent, electricity, and water bills on time for more than a decade, but just got their first credit card, and because it's so new, their credit score shows up as 600. Before this new rule, they would have been automatically disqualified, even though they're excellent borrowers in every other way. But now, they could be included for a mortgage as long as they meet all the other criteria. Essentially, this doesn't mean lenders are throwing caution to the wind or giving loans to just anyone who walks through the door. What it means is that they're no longer depending solely on credit scores if everything else looks good. And honestly, this development isn't really surprising when considering that lenders have been doing everything possible over the past few years to make more loans and bigger loans, like increasing credit limits and allowing previous appraisals to be used in loan approvals. So it makes perfect sense that they would eliminate the minimum credit score requirement in favor of being able to use alternative data sources. This doesn't necessarily mean banks are going to start lending money to people who can't afford to pay it back. But it does indicate that enough people were being disqualified that banks want to change the rules to approve more financing. Now, the second major change that's getting everyone talking is the possibility of portable mortgages. And this one is potentially even more game-changing than the credit score elimination. This was a recent proposal from the Trump administration as a way to transfer current mortgage interest rates from one house to another. Imagine if someone bought a house in 2021 and locked in a fixed 30-year rate of 2.875%. But now they want to move and they're terrified because it would mean giving up that amazing rate and getting a new loan at 7%. Well, portable mortgages would solve this problem completely. Homeowners could simply use their current mortgage to finance their next house, and they'd never be trapped in their current home again. Obviously, this is a pretty controversial idea because on one hand, many sellers are stuck with a frozen real estate market because they can't afford to take on a higher interest rate. So this would completely solve that problem and flood the market with available properties. But there are people who argue this only benefits those who already have low-rate mortgages, while new buyers would still have to get financing at today's higher interest rates. So who's right, and would this actually happen? In theory, here's how it could work. Let's say someone has a 3% mortgage on a $500,000 house, and they want to sell it for a $700,000 house. With a portable mortgage, instead of applying for a new 7% loan, they contact their lender, get a new appraisal, have the property evaluated, and if everything checked out, their current mortgage would automatically transfer to the new house. Simple as that. Of course, if the property is more expensive, the buyer would probably need to get secondary financing at a higher interest rate, and if it's cheaper, they would simply pay the difference. In terms of who benefits most from this, the honest answer is that it's current homeowners, because they get to keep their mortgage interest rate and simply transfer it to the new house. However, the expectation is that this would free up a massive amount of lower-priced inventory that would otherwise never hit the market at an affordable price, allowing more first-time buyers to qualify for financing. But here's where things get really complicated when discussing the actual implementation of something like this. Normally, in a market like this, when someone sells a house, their loan gets paid off completely. And having mortgages with 2 to 4% interest rates sitting on a bank's or investor's balance sheet usually ends up creating massive losses for that company. This is one of the reasons Silicon Valley Bank ended up failing. It's why banks are experiencing some of the largest unrealized losses in history. When they lock up capital for decades at rates far below current market rates, those loans become, for lack of a better word, completely worthless. That's why lenders and investors typically assume that when they make a loan, it will be paid off on average every 12.8 years when the person moves somewhere else. In this case, however, if mortgages become portable, those loans would have to stay on the books at full value for decades. And as a result, lenders and investors would have to raise interest rates for everyone else in order to compensate for this risk. Or if they don't do that, the entire banking system becomes the ultimate bag holder for decades of low-yield residential mortgages, and everyone knows what happened the last time the banking sector became too dependent on residential real estate. Fortunately, there's no need to speculate too much about this because something similar already happens in Canada. That's right. In Canada, it's possible to transfer mortgages from one property to another if borrowers meet the requirements. But there's one major difference. Canada doesn't have 30-year fixed terms. Instead, most of their loans have fixed terms of only 1 to 5 years before being reset. This makes mortgage portability extremely simple because banks don't have to worry about the loan being held to maturity. And even if they do hold it, it's only for a few years until it eventually gets repriced. So, is there any chance of this happening in the United States? The reality is that this would be extremely difficult to implement because lawmakers can't simply retroactively change mortgage laws on tens of millions of existing mortgages. It would be like investors putting money into a company expecting to get everything back in 5 years, and then the government coming along and saying, actually, you're going to get all your money back in 30 years. You disagree? Well, too bad. Here in the United States, there's what's called a due-on-sale clause, which requires that loans stay attached to properties and get paid off completely when properties transfer to new owners. To make mortgages portable, there would need to be complete changes to laws and processes for banks and financial institutions. There would need to be complete rewrites of home financing structures, and new pricing models would be needed for banks and financial institutions that need to hold these low-interest rate loans that have been around for a long time. That's why, as beneficial as portable mortgages could be, the net benefit would need to outweigh slightly higher demand, including increased property tax revenue, freed up housing inventory, and new buyers taking their place. But realistically, it's hard to imagine this happening unless the government guarantees these loans with taxpayer money. And then, yes, anything is possible with enough money. So at the end of the day, this probably isn't going to happen. As beneficial as it could be, it's simply impossible from a logistical standpoint without someone getting seriously burned. So will all these real estate policies simply repeat what happened in 2008? In basic terms, the answer is probably no. Throughout the 2000s, home prices were driven by rampant speculation, easy access to money, and short-term variable rate mortgages that allowed anyone to get loans, even without down payments. These loans were often called ninja loans, short for no income, no job, no assets. Additionally, many of these mortgages also had what's called balloon payments, which meant that after promotional interest periods ended, payments would be much larger, and people simply thought, that's fine. We'll sell the house for a higher price before these payments kick in. And that turned out to be an absolute disaster. When homeowners could no longer afford the higher payments, everyone started selling at the same time, flooding the market with properties. Prices plummeted, liability fell on the banks, and everything went down the drain. While there's been a similar price surge over the past 5 years, this was caused by historically low mortgage interest rates that led people to take on a lot of debt because financing was very cheap. And that debt isn't going anywhere anytime soon because it's fixed until properties are completely paid off. Additionally, today buyers still need to put money down. They still need to meet certain income criteria. They still need to prove their employment. And to summarize, the market isn't seeing people with no money down buying properties they shouldn't be eligible to finance. That's why the chance of a 2008-style crisis caused by something like this is relatively unlikely in the near future. That's why it seems obvious that the current administration wants to do something to help solve the housing affordability crisis. And as beneficial as being able to transfer mortgages from one house to another could be, at the end of the day, the only thing that will make a real difference is building more housing. The real estate market is simply a matter of supply and demand. And when supply is limited by zoning requirements and high construction costs, of course home prices are going to rise. Who knows? Maybe artificial intelligence will one day create perfect 3D houses. And in 30 years, people will be able to press a few buttons and have plans automatically approved through chat interfaces. But for now, construction has to be the number one priority. Otherwise, people better get comfortable with the idea of living with roommates. What do viewers think about these major changes coming to the mortgage industry? Are people optimistic that eliminating credit score requirements will help more individuals achieve homeownership? Or are there concerns about potentially heading toward another lending crisis? Share thoughts in the comments about whether portable mortgages could actually become reality and how these changes might affect personal home buying or selling plans.